Hello, folks. Happy Excel Wednesday. So I think I said that NetSuite was going to be today, and I looked at the schedule and realized that I changed the schedule. There's an unexpected change. This semester is a little bit different than previous semesters, which is why I got confused. Probably also got confused because I'm an old man, and that just happens. I get a little bit dottery, but what it is, what it is. So I want to make sure that I have the calendar set for upcoming, because we are in week 6 and it doesn't feel like week 6. In some ways, it feels like we're in week 2. In some ways, it feels like we're in week 5,000. Just really depends on your perspective and what it is you're working on at the time. But I want to make sure that we're clear on some dates, and I do want to make a slight change. I'm going to announce the change, but I will make the change online so everybody knows this. So real quick to note, we are on chapter 6. We're going to do chapter 6 homework today. We're going to start chapter 7. We're going to do the lecture on Friday. Then homework for chapter 7 will be on Monday. That's it for all the exam, or for all the chapters before our exam, which means that we must have an exam coming up. So our first exam is actually next Friday, so a week from Friday. I have a very particular routine that I do for my exams. I've already got the study guide and the practice exam posted. We will spend next Wednesday, so a week from today, working through the study guide and the practice exam. I do ask my students that they complete the practice exam before they come into class. It really defeats the purpose not to complete the exam before you come into class, because the whole goal is to figure out where it is you're strong and where it is you need help on. So please consider that to complete it. There will also be a practice exam key available. It's on Brightspace right now, but it won't only unlock until once we get to next Wednesday. So all the answers that we'll go through Wednesday, you'll have access to the practice exam key. We then have our exam on Friday. Exam will be in here. We'll take the entire class period. Traditionally, most people finish pretty easily before the 50 minutes. It's 20 multiple choice questions, and I want to say 1 or 2 problems, usually 1 problem with multiple parts. I'm still working on putting that together, but you note that. We will come back after that exam on that Monday. We will have an exam discussion where we will talk about the results. I'll give you the implications. We'll talk about what's going on for the rest of the semester and what we need to consider. The Wednesday before spring break, we will have an in-class activity where we'll be in here together. That will be worth points. If for some reason you cannot attend that activity, you won't get 0 out of 5 points. I just won't include it in your grade, but I would appreciate it if everybody showed up for that, because there'll be some additional points for that. Plus, it will help me. We will not meet on the Friday before spring break. So I've traditionally found that that's kind of one that everybody's kind of got their plans and they're focused on spring break. So we won't have a meeting on spring break. That being said, our first AI deliverable is currently due on the 7th, which is the Friday before spring break. And I realized that because I canceled the AI discussion last week, since we had the weather issues, we're a little bit behind of where I want to be. So I'm going to change the due date of the first AI project deliverable. And I think probably what I'm going to change it to is I'm going to change it to March 31st, which is a Monday. That will give us 2 more sessions to talk about AI research and some AI tools and some things we want to talk about. I know that's a lot closer to the actual due date, but that means that we won't have to worry about it before spring break. That being said, if you've already got some ideas or research, you can start working on that now. It's a very easy assignment. It's not meant to be stressing. But I figured that people would be like, well, I'm not sure what I'm going to be doing yet. I'm not even sure how to use AI tools, Dr. Barnes. That's fair. I don't think that we're probably to that level of mastery yet, which is why I wanted to push this back. I have not made the change on Brightspace yet. I will make the change on Brightspace for all the documents within the next week or so. But keep in mind that 7th due date will change. I will make the changes to the syllabus. I'll make the changes on Brightspace, and then I'm announcing the change in here. Likely the plan is the 31st. So a couple weeks after spring break, after we've had a chance to do some more AI interactions. All right, with that, we got Excel Wednesday today. So like I said, this is not something that I've ever done before. Every Excel activity I've done has been on a Friday. The change to the schedule is kind of necessitated based on some things that we're doing different this semester. But we got Excel Wednesday today. So hopefully you've got a sample data set number 5. By the way, this will be the final Excel data set that we'll have for the exam. So when we go through the exam review next Wednesday, I'll have everything listed that we've done on the Excel assignments, and you'll be responsible for the things that we've covered on the first 5 Excel assignments. So even though no deliverables, hopefully you're saving these Excel data sets and the work that we're doing so you can remember what we're talking about. So you'll notice I've got some students' names here. And by the way, if you look through here and try to find your name, you will not find your name on here. This is actually a randomized name list that I created. The reason for that is I used to actually use student names because I thought that's kind of cool. Use student names, they'll really enjoy that. And then I had that ugly incident where YouTube accused me of cyberbullying, and I said, okay, that's probably fair. I probably shouldn't do that anymore. So nobody's names are in here, at least not intentionally. Like if for some reason your name is a really popular first name and last name, and I got a random combination that might matches those, then that's just weird. But I created a big large data set. I think it was 1,000 names, and they were all like the 1,000 most popular first and last names, and I put them together. And so there's no repetition, but it might, who knows? Okay, it might throw up occasionally. So anyway, we're gonna talk about a few tools, some things that you probably don't think that you're gonna use, and some things that I think you probably should know how to use very thoroughly. If you already know how to use these tools, that's great. You're gonna be way ahead of the game, especially when we start talking about our TVM stuff. I think this is super important, and being able to use this in Excel is gonna give you a big advantage when you make financial decisions in the future. But let's talk about one that are a few tools that I think are really important to use that are a little bit more subtle, a little bit more distinct. So as first, we're going to start out, we're going to look at these names. And I've got these names you notice here. They're alphabetized according to last name. And there's a few things that I might want to do if I want to sort out names. Now, usually the way that I present this information in my grade books, I usually have last name presented, then first name, and then I have full name. I concatenate everything together. But if I wanted to actually present it in different forms or different orders, there might be some ways to do that. An example would be, you notice that I kind of call it students at random when I'm doing my questions at the beginning of the semester. And basically what I do is I take everybody's names and I do a randomized sort of everybody's names. So how do I go about doing that? Well, there's a few things that you need to note. And first thing is we need to know how to do a sort. Now, a sort is pretty easy. There's a couple ways to go about it. If I want to do a sort, for example, and you can kind of see here, I've got the sort here of names. If I wanted to sort these names according to alphabetical order by first name, I could go click on data, sort, and I'm just going to continue with current selection. We'll work on this a little bit, but I can actually sort according to student name, and then we'll go by first name then, which is relevant, but not particularly relevant. It's there's not a reason I do that. The only time that I would actually need to do that, as weird as it sounds, bright space, the grades are presented all according to last name, except for the quizzes. All the quizzes are sorted to first name. I don't know why it does that. It's really, really strange. But I might need to sort grades according to first name, so that would be the reason I do that. Something that's actually a lot more reasonable to use. You're probably very familiar with this. Is going to be something called autofilter. So the first row, if I I don't think you need to click on first row. It just does automatically. Click on this thing called filter. It looks like a funnel. It will actually set up filtering options, which includes sort, but a whole bunch of other things. You can actually select according to records within the selection. Sort A to Z, Z to A. You can sort by color. You can set up text filters. There's a whole bunch of ways you can do about it. You're probably familiar with that already, but this is very, very useful and very helpful. I do think that autofilter is a tool that doesn't get used nearly as much as it should, but you can automatically set for a lot of these lists up and just have them automatically set up an autofilter, and it can be helpful. That being said, we're going to do a specific type of sorting, which is going to be a randomized sort. And there's two steps to this. The first of this is going to be use the rand function. Okay. So the rand function is not one that I set. If you asked me 20 years ago, what would be the most common formula that I would use in Excel, I would not have put this on my list. And it's just amazing how many times I use this. And it's for creative application purposes. But the rand function is basically equals RAND. And that's weird because that's how you set up a formula. But the rand formula, you don't actually have to put any inputs in. It's just close parentheses. So I'm going to set equals rand. And then assigns a random number between 0 and 1. You can see the decimal places there. And the interesting thing about the rand function, why it's so useful, is because it randomizes whenever you put any new inputs into Excel. So we're just going to go ahead and we're going to autofilter this. And you will notice that my value that was in this cell automatically changed. So I put new information in. And that's true for any time you put new information in. Like if I just go through here and say, all right, I'm going to hit enter, it's going to re-enter anything that's got a random assortment there. That's really weird. That's a 0.2. That's all the zeros. I've never seen it randomized to 4 decimal places before. That's amazing. All right. I guess it was bound to happen eventually. So anyway. So yeah, you can kind of see the these. And the reason this is important is because when we do a randomized sort, now I've got a seed that I can set up for sorting. And every time I sort it out, it's going to be different. So I'm going to sort by B, which is my seed. And it's just going to give me a randomized sort according to this row. But you will notice that immediately after I sort this information, I get random number inputs again. So it's no longer sorted according to the seed because they have new numbers and new values in here. Why is this important? Well, if I want to sort it again, I get a new randomization option. And I can continue doing this randomization option for as many times as I want to. Which again doesn't sound like it's very useful, but if you're trying to randomize and you want it to be true randomization, having this tool that's just very, very quick that you can just do a quick sort and have that availability is really, really powerful and potent. Again, it doesn't seem like you use that, but you'll be surprised how often it comes up, something like that. Probably more relevant would be something using where a randomized set where you want to actually have a randomized set, but you want to specify certain values. Now, of course, we could do mathematic manipulation of this. So if I wanted to say I wanted a number between 1 and 100, I could just multiply this times 100. And I could probably say, all right, equals this times 100. And I get a fair approximation. Whoops. Maybe times both. Yeah. Okay. Even that's not perfect because it's too small. It's not going to round. So you get to round to the nearest one. Probably more relevant here, something that would probably be more relevant than trying to multiply this or doing this as a function, would be specifying a certain range of values. And that's where we're going to use something called rand between. Between. So it's rand between. You can see the function. We click on the function. It's going to say, give us the bottom and top range. And it will specify what is going to be your top value and what's going to be your bottom value. And these are going to be set as integers if you set them as integers here. So I'm going to say 0 to 100. And just like before, we have randomized values, but now they're within specific parameters. I will say I don't use this nearly as often, but it still comes up occasionally, especially if you need to assign random assessments in certain scenarios. So this is one that, again, I find practical uses for it in situations where I did not think I'd find practical uses for it. I can't give you a whole lot of scenarios. I can say that when I need to randomize group assignments for my graduate classes, this comes up very, very frequently about how do I do true randomization. The rand function can be very helpful in that regard. So that comes up quite frequently when I'm talking about semesters, but it comes up in a lot of different contexts. So a very, very simple tool, very, very potent tool using the rand and the rand between functions. All right, let's talk about some things that are going to be more practical for your financial planning. So you learned time value of money back in your 221 class. You probably learned it in your finance classes and have used it in other classes as well. I'm a big advocate for knowledge of time value of money because it gives a very, very clear indication of your financial well-being for planning purposes. I was terrible when it came to financial well-being and financial literacy when I was younger. I probably shouldn't say I was bad with financial literacy. I knew the concepts, I just didn't ever apply them, okay? You know, you hear, don't max out your credit cards. I was like, oh, I'll just max out my credit cards. Yeah, bad idea, okay? Bad idea. Now, I'm not here to preach to you about financial well-being or financial literacy. I'm assuming that you can adapt that to your own. But one thing I do think is really important, and I tell students who are outside of the business school this, is that learn to use a spreadsheet because there's so much stuff you can do on a spreadsheet that's going to be relevant and applicable. If you are using like a financial app, like say, all right, if I want to buy a car and I get a 5% interest rate and I'm going to buy it over 60 months and the car costs $35,000, how much are my payments? You have apps that can do that. But the great thing about using a spreadsheet is that if you know how to use the inputs, you can calculate this yourself and do the amortization yourself. Is anybody taking 303 right now or taking 303? So yeah, those amortization tables that you have to do in there, when you do them by hand, they suck. Okay, but doing amortization tables in Excel is just kind of beautiful because you get everything set up and you say copy down 360 rows. So you get just like a mortgage, and it's just like beautiful when it all works out. And just like you're just kind of like, I have accomplished something today. I should be proud. So I'm a big fan of these time value of money tools and these financial tools. I've got some very simple ones, and I do want to do some applications here. You can actually adapt these to your own purposes, but these are the formulas that are very, very potent for time value of money analysis. And they should look familiar because they're going to be the same tools that you used for your finance classes and for your for accounting 221. So let's talk about some practical considerations. So you want to put enough into an investment account today to have $100,000 in 10 years. Now, just as a note, okay, $100,000 is not enough to retire on. All right, I'm not making that the statement. In fact, I think the number used to be $1 million for every person in your household. With the rates of inflation going up the way they are right now, we're probably getting closer to like $2 million, which sounds like a lot right now. But if you make the decision early to be financially knowledgeable and take the responsibility for it, it's actually not that big a deal. I didn't start really actively saving until my mid-30s, and I'm paying for it now because I'm putting away tons of money right now, and it's growing at a very, very small rate. If I'd done this back when I was in my 20s, I could just be kind of like, all right, I'm about ready to retire, which would cause Dr. Caden panic and pandemonium, but yeah, that would be at least an option for me. So anyway, let's go ahead and think about what we need for $100,000 in 10 years. Assuming you can generate a 7% rate of return compounded annually, how much would you need to invest? So basically, we're asking what's the present value of that $100,000. So we're going to use a formula called PV. So equals PV. And the good news is once you put these formulas in, the inputs are pretty self-explanatory. They're consistent, they're cross. So we're going to talk about each of these. So first of all, we're going to say rate, and this one's easy because it's annualized. So we're just going to say 7%. So you can actually say 7%, or you can type in 0.07. Either one of those is fine. All right. It says 10 years. Then we're not actually making any payments. It's saying, okay, I want to invest something now and have $100,000 in the future. So our payment is going to be 0. And then future values. So future value, I want to make a note of this. This kind of gets a little bit confusing. I like to return all my values as positive numbers. Technically speaking, what you should be doing is if it's an outflow, it should be a negative number. If it's an inflow, it should be a positive number. But just for context, because I like all my numbers to be positive, my results, I always make my inputs negative. Because by doing a negative input, you will get a positive output. So I'm just going to put negative 100,000. Strictly speaking, this is incorrect, okay? Because I want my inflow to be positive, but because I'm trying to get all my outputs to be negative, or my positive, I'm going to put an input as negative. By the way, if you're asking, can we just put a negative sign at the beginning? That's perfectly fine too. You can do either one of those. But yeah, if I do that, we get $50,834.93. So yeah, assuming that I get 7% rate of return compounded annually in 10 years, basically that 50,000 will return 100,000. By the way, has anybody heard of the rule of 70 when it comes to investing? Basically, if you take your rate of return, multiply it times the number of years, if that number is around 70, you can assume that it's going to double over that time frame. So 7%, 10 years, it's going to double in 10 years. Conversely, if you got a 10% rate of return, it would double in 7 years. If you had an 8% rate of return, it would double in 9 years. 9% rate of return, double 8 years. 6%, 12 years. Everybody see where I'm going with this? Yeah. Those numbers are not precise, but that's a general guideline that we tend to adapt to. All right. Let's go ahead and talk a little bit about this. So let's just go ahead and say that you're going to put $60,000 into an investment account that yields 7% per year compound annually. If you leave it in place for 10 years, how much can you expect to have at the end of the 10-year period? Well, this is actually another rule of 70 question, which we probably can say that's going to be around $120,000, Dr. Barnes. All right. We don't need the Excel spreadsheet to give a general number, but what can we do if we want to get the exact number? Well, this is just the opposite. This is asking if we put something in now, what are we going to get in the future, which is going to be a future value question. So we're going to do equals future value. Same set of inputs, 7%. Number of periods is going to be 10. Again, there's no payments here. But then we need a present value, and the present value is 60,000, which I'm going to put in a negative value so I can get a positive output, which in this situation is technically correct. So my result is $118,029.08, which is roughly double what I originally invested. That's a pretty good analysis. So yeah, so this is pretty simple and straightforward, but there is a fundamental problem with these types of questions. Basically, nobody in this room has $60,000 that they can just say, oh, I'm just going to put this away and not use this for any purpose right now. At least I'm assuming nobody does. If you do, congratulations on your success, first of all, okay? Secondly, don't tell anyone, all right? But we just don't have $60,000 that we can leave lying around. So we don't have $60,000 lying around, so you decide to make payments to your investment account of $1,000 at the end of each month, which is a more reasonable assumption. Now, $1,000 sounds like a lot, but I expect everybody in this room to be super successful upon graduation, where $1,000 is not that big a deal. I actually advocate when you're first starting out, right around $300 to $500 if you can manage it. I did some math. If you're $300 over a 40-year period at the average market rate of return, that's about 1.9 million when you retire at 65. So that's a pretty impressive rate of return. If you can manage more than that, more that you can manage early, the better off that you'll be later on. So $1,000 at the end of each month, sending a rate of return at 7% compound monthly. How much can you expect the investment to be worth in 10 years? All right, so we're going to do a monthly payment calculation. So in this situation, we're still going to do future value, but this is going to be based on payments. So here we go. Equals future value. Now we're going to do 7%, but we need to make a little bit of an adjustment because it says compounded monthly. And I'm assuming everybody's familiar with the idea of compounded interest. If we say compounded annually, that means the interest is added in at the end of every year. If it's compounded monthly, then it's going to be compounded at the end of every month. So we're going to say 7% divided by 12. And then our number of periods is going to be 10 years, but times the number of months, which is going to be 12. You could type in 120, but I'm just going to do the math. And then for payments, this is where we're getting our source of funding. We're not doing a one-time input. We're doing consistent inputs of $1,000. So I'm going to type in negative 1,000 because that's the amount of input. I don't need to put in present value because the present value is 0. So that's a little bit more reasonable. That's $173,000 at the end of 10 years if you get a 7% rate of return. So not a bad return on investment, I would say there. All right, moving on. They say that you have the goal of accumulating $100,000 by making payments to an investment account at the end of every 10 years. Every month for 10 years, not every 10 years, but every month every 10 years. Assuming a rate of return is 7% compounded monthly, how much would your monthly payments need to be to reach your goal? So instead of saying you have payments that you know what you're going to be making, now we say I want $100,000 at the end of 10 years. How much do I need to pay every month to achieve that goal? Well, we know it's going to be less than $1,000 because $1,000 would be $173,000. Okay, but what would be 100,000? We actually have a function for that. We're going to have payment equals PMT. And the good news about the payment function is it's very, very similar to what we've been dealing with already. Now we need to be very careful about our inputs here because the inputs are really, really specific here. So first of all, 7% is going to be your rate of return. But again, we divide that by 12 because we're doing this on a monthly basis, compounded monthly. The number of periods is 120 again, or 10 times 12, whichever you prefer. In this scenario, we want to have $100,000 in the future. What is our present value? 0. 0 is our present value because we don't have anything right now. We're going to be making payments. We'll accumulate some in the short term, but we don't have anything right now. But our future value is going to be $100,000, which I'm going to put a negative because I was like getting a positive result. That means that if I want to accumulate $100,000, I need to make about $578 per month on my payments, assuming that I get 7% compounded monthly. Okay, which again is pretty reasonable. Pretty reasonable. It's important to note that we're doing a very short time frame here. If I change these time frames just even so slightly, like say for example, just for context, I keep saying how long is term. Let's say that I do this over a 40-year period as opposed to a 10-year period. So if I change this to 480 months, that's not going to work. Let's do the future value. So let's say I do this over 40 years instead of 10 years. That's a much larger number, okay? So remember, if it was just 10 years, $1,000 per month, I was just saying that was only going to be $170-something thousand. If I do over 40 years, that's $2.6 million, which I'm going to assume that if I ask you, would you rather have $170,000 or $2.6 million, you're going to go for the $2.6 million? Somebody in the class is going to be saying, I don't want those taxes, Dr. Barnes. I'm going to say, you fool. Yeah, but yeah, make sure that we take the larger number. Okay, that's obviously the goal here. All right. So kind of wrap up, let's talk about a few tools that are a little bit less relevant, but still you might want to run into. And you're probably familiar with these. Now, let's assume that you've accumulated $100,000 you want to retire. I want to reiterate, do not retire at $100,000, okay? Bad idea, bad idea. You'll be going back to the workplace very, very quickly. I would say don't retire at $1 million, maybe retire at $2 million. The number is going to change over the next 40 years as you all start to go to the workforce. Right now, probably $2 million would be safe, but certainly not $100,000. So if you accumulate $100,000, you want to retire, your plan is to withdraw $10,000 every year for the next 20 years. So assuming that you get a rate of return of 7%, we're going to determine if the plan will work. So basically, you can kind of see here that I've set up net present value, and I got 20 years at $10,000, and I got a beginning of $100,000. So we're going to use the net present value function. And net present value is a pretty simple function. It requires you to do a little bit of work at the front end, but we're going to say 7%. And then we're just going to highlight C28 through C48. So 7% and then C28 through C48 because it can actually recognize the series. And it says that our net present value is negative $5,551.54. What does this tell us right here? Will our plan work or not? It will not. It's telling us that we're short what we need if we wanted to withdraw $10,000 at the end of every year for the next 20 years. All right. So, yeah. What does that mean? It means our rate of return would need to be higher if we wanted this plan to work. Either we need more money, which again, more money is always better, or we need a higher rate of return. So what rate of return would we need in order for this plan to work? Well, that's where we're going to use the IRR function. Now, if you remember IRR was very imprecise when you did not have a financial calculator. If you have a financial calculator, it's pretty easy, but it's very imprecise. You have to do trial and error calculations. So you can have a financial calculator, or you've just got an Excel spreadsheet lying around, which I highly encourage. Then you can actually do this calculation as well. So let's go ahead and do equals IRR. And all we need for IRR is we need our beginning values and then our disbursement values. So basically the same set of inputs we had for NPV. And it tells us 7.75%. So if we wanted this plan to work, we'd need a rate of return of at least 7.75% annually in order for this to work. So yeah, these are very simple tools, but they're very, very powerful. Again, having the power to be able to make the judgments of your own and be able to see how the finances break down. It's something simple as like going to a car loan and saying, all right, I really want to know what the value will be at the point in time. Like after a year of paying off my loan, what is the principal that I still owe? Doing something like that, it seems so mundane, but it's very, very powerful when you're doing financial planning to be able to look into that. Yes.
Good question. If you type in the 7.75% into the NPV, it still doesn't show.
That's interesting. I've never actually checked that. It's pretty close. It's rounding to $32.74. So keep in mind that the actual number is probably 7.7535257556, like so rounding error. So it's not quite there, but you're correct. It's not exactly correct. All right, that was fun stuff. Let's go ahead and do some homework stuff. All right. So the first question, this is a very easy question, but like I said, I want everybody to be thinking about processes and what's relevant to a given process. It's very, very interesting to me how when a simple question comes up like this, it just gets confusing. So again, this is an easy question. If you answered it and didn't have any problem with it, great. But if you are struggling with it, we need to get our mindset working. So keep in mind, we're in this chapter. We're in the purchasing process. When we're in the purchasing process, we are the customers and we're dealing with suppliers or vendors, all right? So which of the following is not an activity in the purchasing and payments process, so which is not part of the purchasing process? Requesting prices, yeah, we want to know from the vendor what they're going to sell us at. Receiving the items, presumably they're going to send us the goods. Pay for items, yes, because we always pay for our goods because we're responsible individuals. Bill customers, what process is that part of? That's the revenue process, okay? That's the revenue process, not the purchasing process. Again, simple question, but you do need to have your mindset thinking about what process am I in, and if something kind of stands out in that process that doesn't fit, like customers, you should never see that word in the purchasing process because we're not dealing with customers in the purchasing process. We are the customers. So D is our answer. Question number 2, which activity results in an increase to accounts payable? So this is a kind of a shaded question. The reason I chose this question is one of the things that I said that was really important to understand. When we're talking about these functional process areas, we need to know what point do we recognize the liability for receiving the goods and services? At what point do we recognize that account or that payable that we owe? All right, so let's go through. Request prices. Well, the vendor's not done anything yet. They've not sent us any goods. They've not provided any services. So request price is not going to be the case. Place the purchase order. That's where we say, hey, please send us something, but they haven't done anything yet. Receive items. All right, now that's more interesting. The goods have reached our dock, and now we have the obligation to pay the vendor. That's where we would record the transaction, inventory or purchases. Remember, that was the debit, okay? And then credit to accounts payable. This is our liability recognition event. And that BPMN diagram, that's where we had the little bracket below that says record purchases. This is our answer. C is our answer. Return rejected items, that would actually affect our amounts, but that would not be the liability reduction event. Send payment, that's where we actually pay for that payable, but that's not the recognition of the payable, that's the removal of the payable. Question number 4. Which of the following is not an example of an application control? So application control, what was the other type of control we talked about in IT system? Application control is what the system does. IT controls can also have other types of controls. What are those? Access, yeah, access or general control. What do we characterize to use when we talk about access controls? What term are we looking for? So we're looking for the words employee, generally speaking. Usually it's going to be users, okay, at a more general level, but we're looking for the word employee. And I'll tell you right now, all the examples we're going to look for are going to have the example of employee or a reference to employees within the organization. We're talking about application control. What's that? What's responsible for application controls? What entity? The system, okay? The system. So let's go ahead and go through which of the following is not example. Range checks ensure that purchases are limited to valid amounts. What entity is responsible for the range checks? The system, the IT system itself, okay? Employee make disbursements cannot modify purchase orders. All right. Is that access or application? That's access because we're talking about an employee, okay? We're talking about employees. So that's our answer. System suppliers, supplies supplier addresses for payment. We see the word system there. System creates audit trail documenting all changes to the system there, okay? So when we talk about what the system does, again, that's application control. We talk about what the employee does, that's access control. This is our access control. It's not an application control. So B is our answer. All right, question number 6. Which of the following is a resource and I guess I'm going to say the purchasing process. So payment terms of payment structure model. So we're talking about a resource. This is the UML diagram. That's basically what they're asking. Those are our structure models for the UML diagrams. So which of these is going to be a resource? Well, let's just go ahead and go through these. So these next few questions all have a commonality. It's going to ask which of the following is a certain entity within the purchasing process. So we need to make sure of 2 things. First of all, it has to be part of the purchasing process. First of all, purchasing process. Secondly, it needs to be that class that has been identified. So we're going to talk about whether this is part of the purchasing process, and if so, what class is it, okay? So, employee labor. Is that one of the items that we identified in the purchasing process? That's not even our UML diagram, so we can toss out A. That's not, it's part of another process area, but it's not in our UML diagram for the purchasing process. All right. Receipt of goods. All right. Is that something that would be considered part of the purchasing process? Yes. Okay. And if we're saying that, what would it be? What would receipt of goods be in that regard? It's part of a sub-process of the UML diagram, but it would be considered to be a sub-process of a resource event or an agent. It would be event, and to be an event, okay? Because that's when we receive the goods, okay? Receive the goods sounds like an event. Paying by check, okay? Paying by check is kind of disguised, but it sure sounds like cash disbursement, which is what? An event, good, okay? Inventory. So inventory, is that going to be in our UML diagram for the purchasing process? Yes. What class is it? It's a resource, okay? And that's what we're actually looking for is a resource within our purchasing process. So D is our answer, but just for context, let's look at E. E, is that going to be in our purchasing process? Yeah, suppliers and vendors are definitely in there. Is it going to be a resource, event, or an agent? Agent, good. All right. All right, moving forward, which the following is an agent in the purchasing process model. So the good news is that basically we have the same answers. They did change paying by check to cash disbursement, which I think is funny. But down here was the one we identified as an agent down here, supplier in the purchasing process. Since we already identified it in part 6, we can answer question 7. The answer is E. All right. And then question number 8, they decided to mess with us. Which of the following is an event, the purchasing process, the structure model, and they changed the answers. So let's just go ahead and go through the answers. First of all, cash. Is cash an item in our purchasing process? Yes. So what kind of class is it? Resource, event, or agent? Resource, good. All right. Inventory, is it one of our classes? Yes. Which class is it? It's also a resource. Employee, is that one of our classes? Yes. Which class is it? Agent. And then cash disbursement, is that one of our classes? Yes. And hopefully it's an event because we don't have anything left, okay? So it is an event, so D is our answer. By the way, has anybody noticed that all the last answers that say all of the above and none of the above, none of them have been correct so far? It's like I did that intentionally. Weird, huh? Yeah. All right, had to make you think about these things. Question number 9. Which of the following events would indicate the recording of a purchase in the AIS? This is another liability recognition question, which again is just basically the same thing we asked before, but I do think this is important, which is why I asked you another question about it. All right, so let's go through the answers. Issue the purchase order? No. Issue the purchase order is basically saying we want you to do something for us, but they've no longer done something for us. The vendor's no longer done the thing for us. So they say receive the goods. There we have our recognition event. That's where we record the purchase transactions, where we record the receipt of the inventory or the purchase, and we recognize the accounts payable. So B is our answer. Make payments, again, make payment will require a transaction, but that's actually we record the accounts payable being paid off. Transfer inventory doesn't have any relevance here. We haven't even talked about that as one of the transactions, so we can ignore that. So B is our answer. C again is a transactional event, but that's the payments. That's the cash payments right there. All the way down to 26. So before we get to go involved in 26, I'm going to make sure that we pull up our slides here so we can actually look at these. So we'll look at the BPMN diagrams that we talked about in this process area. So these questions I think are interesting. I don't know that I would necessarily ask either of these questions on the exam, but I do think it's important to think about these things, all right? So assume that you're drawing an activity BPMN diagram of a purchasing process. Which of the following is not true about your diagram? So I want to talk through each of these individually, and I'm going to skip a few because I want to talk about them at certain points, okay? So the issue purchase order task occurs before the receive purchases task. What do y'all think? Is that an accurate statement? So place purchase order, receive items. It sure looks like it's before that diagram. So A is correct. So we can ignore A because we're asking which of the following is not true, all right? I want to go down to D. The process ends when the vendor is paid. What do y'all think? That seem correct? Payments made to occurred, we're done. All right, so that's true too. Well, let's talk about B. B is a little bit kind of confusing. It's not something we've talked about, but again, this is one of those points that you have to use your judgment to make a determination of what's happening here. The purchases task can be modeled as a looping task to show multiple purchase orders following one purchase order. So what is that saying? Could I actually add a loop here where it comes back and replaces purchase orders again and again on a periodic basis? Does that occur in businesses? So they say, we're going to engage in a contract. Every month you're going to send us the same quantity of goods at the same terms for the next year. Does that seem like a feasible contract to engage in? Yes. And that's all this is asking, is that we could actually have a loop here, say, clock here, 1 month, come back and replace purchase order again and again and over again. So even though we didn't talk about this, again, I want you to think about this intuitively. Is that something that could occur? The answer is yes. So B is a possibility, which leaves us C. The process starts when a customer places a sales order. What process are we in again? Are we in the sales process, or the revenue process, or the purchasing process? Purchasing process. Customers are related to revenues, okay? Customers are not relevant to this decision process. So C is our answer. That's not part of this process diagram. All right. Assuming you're drawing a collaboration activity BPM and diagram of the process. Now it sounds really, really complex, but all this means is that we're collaborating with external parties. We've already looked at a diagram like that. So we're collaborating with our suppliers, all right? Which of the following would not be a message flow on your diagram? So let's just take a look. What are our message flows in our diagram here? Because this is the one we looked at, all right? Got a message flow about the quote, about the purchase order, about the delivery, about the receipt of invoice, and the payment. So let's go through. Purchase order, yes. Delivery, yes. Disbursement, payment, yes. Inventory updates. So inventory update would basically say, we're out of inventory, we need to reorder new inventory. Is that something that's modeled as part of the purchasing process? No, okay. It's not modeled specifically there. That would be part of the inventory process we're going to look at before. So even though it's not listed in there, that's one of those, because it's not listed in there. Again, these questions are a little bit more obscure, a little bit more challenging to look for, but this is kind of the way I want you to think about this. Again, I do not think either of these questions would make the exam, but I do think that they have value in their own right. Moving on. Discussion question number 3. Draw an activity model for BPMN using the process you followed when you purchased your textbooks in the current semester. All right. So let's just go ahead and look at a very basic diagram of this. See what y'all think. See if you think of the accuracy of the diagram. So again, the goal here, not to have exactly what I wrote down, but to have something that's intuitively sensible. So you take your classes, you go and look and you see, all right, I'm taking AIS with Dr. Barnes and I'm taking another course with another professor, and you see the textbooks and you get the required textbooks because the bookstore publishes those and say these are required for that. All right. So you determine what the textbooks are, you make that decision, then you say, all right, where am I going to purchase them? And presumably there's only a limited number of options. All right. Some of you may be saying, well, I didn't purchase them, Dr. Barnes. Okay. What I did is I found it online for free and I just downloaded it. And if that's the case, don't talk to me. Okay. Okay. I can't hear that stuff. I can't hear you telling me that, but that's certainly a personally feasible option. So we're going to say you purchase from the bookstore or you go to Amazon, you buy them online. Whichever is the case, you're going to actually make that decision point. So you have a gateway here. because we have multiple options. And I do admire this particular BBN diagram because it does close the gateway, because you have decision point and it closes the decision point. Regardless of that's how you're going to receive your textbook. That's all there really was to this. There are iterations on this and variations, but all I want you to identify is the activities of saying, all right, what do I need? Where am I going to acquire it? What is the sources that I use to acquire? And then I'm going to receive those items. This is kind of a traditional, simplified version of the purchasing process, but this would be your own personal purchasing process. Now, I notice here that there's some simplifications over other BPMN diagrams. We do not have a record receipt of inventory and then a subsequent payment. Why do we not see this in the diagram when we see in other BPMN diagrams? So if you're an individual buying books, are you going to say this is a business consumer environment or business customer environment or business to business environment? Business to customer, okay? What does not exist in business to customer? The extension of credit. Like you aren't going to go to the bookstore and say, all right, I'd like to buy these books. Can we arrange terms that I'll pay you in 30 days? They're going to look at you and say, no, we don't operate that way. So well, I'm going to another bookstore then. No, it's not the way that works, okay? Business to customer, you usually pay a point of sale. You pay at that point in time, which is why we don't have that payment event occurring at the end. So if you use the diagram, if you use this the simplified version of the purchasing process, you would have to adapt this to note that there's no invoice, there's no payment. Basically, the end of this cycle is when you receive the items and make the payment on them there. That point in time is the same point in time. Okay. Moving on. Got our problem here. So I said problem parts 1, A and C. So we've got a tablet store, and I'm not going to go through the narrative mostly because we've only got 5 minutes, and I do want to talk about both the answers real quick. But it gave you a little bit of a narrative of the tablet store. One thing that's kind of note is that the purchases always are dictated by a purchase order, which is kind of important to note. Remember, we talked about this a little bit on Monday, that if you always have a purchase associated with the purchase order, you can simplify your diagram. But for the purposes of our UML diagram, let's just go ahead and let's make sure that we understand what we need to do. So the very first step in any UML diagram creation is making sure we know what the resources, events, and agents are. So our events, if we assume that we're going to do a traditional diagram, we could say purchase order followed by purchases and then cash disbursement. If we are going to simplify this, which the solution I'm going to give you is a simplified version, we could merge the purchase order and purchases. And the example I gave you on Monday said purchase order was the example, but it's basically just a big purchasing blurb. So several events that occur all within the same realm. What are our resources? Okay, we've got our products, which in this case would be our tablets. And then what's our other resource? Cash, good old money. Okay, who are our agents? Okay, we've got the employees for the tablet store, so the tablet store associates or the tablet store employees. And then we've got the suppliers or the vendors. Actually, in the diagram we're going to look at, they call them manufacturers, another term for it in this particular scenario that's applicable. All of them are fairly synonymous. If you put them in there as one term, I would accept any one of those terms in this particular scenario. So actually, let's go ahead and look at the diagram, what it looks like. Again, this is just an intuition or iteration on the diagram we've already looked like. If you use this diagram here, that I said was kind of our foundational diagram, this would technically be correct too. It does simplify a little bit on this because remember, we're merging purchase order and purchases. I don't necessarily like the solution because they say purchases, whereas the simplified version of the book called this purchase orders, because it said a purchase order always has to result in a purchase. Either way, the intuition is the same. We have our products, our cash, our purchasing step here, our cash disbursement that occurs later, then our employees and our suppliers, our manufacturers. So however that works, however you want to set it. Yes.
If on an exam I said payment instead of cash disbursement, would that still be acceptable?
That would be absolutely fine. Yeah. As long as it's representative of whatever the resource or whatever the class is. Now, say for example, you put cash disbursement over here, I would say that's a problem because cash disbursement specifically represents an event, whereas we're a resource. So the aggregation needs to be resource, event, and agent. But as long as your intuition or as long as your representation is consistent with that, that would be correct. All right. Last question, something we haven't talked about, but I'm sure you know from accounting, says, describe how you would use a relational database to determine the tablet store's accounts payable. So we have this UML diagram of information that's going to go into our database. So for each of these items that's listed here, we're going to have a table representing each of these because these all represent entities. Remember, relational databases are entities. The tables themselves are the entities. So which of these tables would I use if I wanted to determine what accounts payable is? So accounts payable is effectively purchases minus something else. Minus, yeah,
Minus disbursements?
yes, minus disbursements, because if we've already paid for the payable's been eliminated. So if I wanted to use a relational database to determine my accounts payable, I would take all of my purchases that are listed in this table here. I'd subtract all the cash disbursements in this table here, and the net result of those would be accounts payable. And I think this is an interesting question because this actually shows the relationship between what we talked about in relational databases and our UML diagrams. So it's kind of an interesting point to make. Again, it's a little bit more nuanced, a little bit more detailed than what I would normally ask you on an exam. But again, I want you to think about these questions in a big picture context. All right, we are done for today. We have chapter 7 lecture on Monday on Friday, and then homework on Monday. So I'll see you all on Friday.